So let's begin. Good morning, ladies and gentlemen. Welcome to our latest edition of Czech National Bank meeting with analysts. Today we are going to present you our new macroeconomic forecast, which was prepared by our monetary department. Let me introduce you my today's speakers. We have Jan Kubíček here, Czech National Bank board member. Also Jakub Matějů, acting director of the monetary department, and Tatiana Keseliová, forecasting team leader. So we will start with the presentation, and then we will open the floor for your questions and further discussion. So it's up to you, Jakub.
Thanks a lot for the floor. It's always a pleasure to present to you our primary highly educated, highly expert audience who then serve us as intermediaries in the communication vis-a-vis the more general public. So it's very important that you understand what we are doing, that you hear the messages which we are sending. So thanks a lot for coming, and I will very briefly go through the forecast, the scenarios which we have prepared for the monetary policy meeting, and then we'll be more than happy to answer any of your questions which you may have. So going right away and in the presentation, I will start with the most important thing, the headline numbers for the coming years. So we revise headline inflation mildly up to 2.5 for this year, then 2.2 next year. I have to say and admit that already this year is under a slight risk downwards after the flash estimate was 2 decimal point below our expectation for April, which would drive the year-on-year number 1 or 2 decimal points downwards to something like 2.3 to 2.4 for 25. GDP, there we stay relatively unchanged for this year, which okay, the whole forecast doesn't seem to be massively revised, but this hides some underlying counteracting forces which roughly compensate each other. We see we call it something like a dual development or two-track dual track development in domestic economy where we see relatively strong consumer demand and overall domestic demand in the economy. On the other hand, we see very weak and risky foreign demand and foreign developments, which brings risks in the direction of lower growth. So this dual development is an underlying theme and topic, a red line of this forecast round and monetary policy round in general. Jumping right away in the foreign economic outlook, this forecast was prepared in an environment of great uncertainty with the tariff trade war the environment being changed every week at least. So we had this Independence Day, then we had some postponements of the tariffs, some mutual negotiation, some news. So this was a very volatile environment. So we had to say at one point stop, and this will be our baseline. Our baseline is based on the 10% universal tariffs from the US against almost everybody else, with very little on the retaliatory tariffs from the Euro area or European Union against the EU. So very limited retaliatory measures, but this flat 10% tariff against everybody. So this is the assumption on the tariff side. But already this development led to great market volatility with oil prices being falling rapidly, like from levels above 70 or 75 down below 65, then even below 60. But our cutoff point saved us relatively close to the levels which we observe now. So 24, 23, 64, 63. So we are relatively close to the current levels with the forecast and with the outlook also. Then we saw a massive devaluation of US dollar. Again, there was a moment when it seemed that euro dollar rate would be 115 and tending upwards towards 120. But our baseline is again relatively close to the current values from this morning. So you can see how successful we were in forecasting the China-US progress in trade talks, which the news which unbelievable. So we forecasted this morning pretty well. Dollar is back to 111. But that said, we still work with relatively huge downgrades, revisions in foreign interest rates, both in the U.S. and in Euro area, where we work with Euribor straight market expected trajectory, which bottoms out at 175 in the second half of this year, so below relatively substantially below a neutral level for the ECB. So this foreign news as a whole relatively anti-inflationary in the direction of weaker growth. But coupled with domestic price pressures, this leads to inflation staying still in the upper bound of inflation target after April, returning there, and converging from above to the target only at the monetary policy horizon around second half of next year, let's say. This is revised very slightly upwards from the previous forecast, but as I said, April already is below this forecast, so the revision to the trajectory of inflation is very small. Going forward, the inflation will be driven by core inflation, which we still expect to approach 3% in summer months. In June, I think we have the peak of core inflation. We expect the peak of core inflation based on the base effects, but also there will be a substantial contribution from food prices, which will stay elevated around 4% in the rest of the year. Following on the increased growth in agriculture producer prices, we still see rise in prices of some imported food commodities. So this pass-through is still incomplete, and we expect the food prices to reflect that. Administered prices in Czech relatively in 1% this year, I think 0.9. Next year, very close to 2%. Fuel prices contribute negatively, and with the observed drop in oil prices, this will continue to be the case. Then it's important to look at the inflation through the lens of cost pressures. This is, in the end, the basic logic of our forecasting model, how it perceives the inflation and inflation pressures and how the price process forms. So we still see elevated contribution from costs, and we see a negative contribution from correction and the still positive gap in profit markups. So these are the two counteracting forces which balance each other to some extent, with a result of slightly above target inflation now and also going forward in the next quarters, with the exception of April. Looking more in the structure of costs, what we should mention is negative contribution of energy prices following from the fall in oil prices. So this is the gray bar pushing inflationary pressures downwards this quarter and the next. For the next 2 months, but on the other hand, we still see substantial pressures from domestic economy and also from imported core prices. In the domestic economy, you see the main contributor is wages in market sectors, with only slowly growing contribution from labor efficiency, only making some substantially negative contribution next year. The real economy, we have been quite successful in getting the GDP flash, so this does not pose any big risk for the forecast. It's basically on the forecast for the first quarter. The flash has been released after we finalized the forecast and after we distributed it to the bank board, so we did not know the number. Also, the compositions from the Czech Statistical Office commentary seems to be more or less in line with what we expected. So big contribution from household consumption, and we think that there will be continued contribution negative contribution from gross fixed capital formation, and also from net exports. I will shortly tell you why. Household consumption, according to the forecast, will increase 3.4 this year on the back of growing real wages. We also have low inflation environment, relatively stable sentiment given the uncertainty we see in the foreign news and foreign markets. So the domestic consumers are relatively optimistic, keeping in mind what is happening abroad. Then we observe and we expect going forward a gradual decline in the saving rate, which will create additional space for the household consumption to accelerate somewhat further. The gross capital formation can be disentangled in a differing forces. One is already observed quite big contribution of change in inventories, which was getting stronger throughout previous year, peaking in the fourth quarter when the inventories formation reached, like it touched zero, no? That the inventories at least stopped declining, and we expect the inventories formation to return to previously observed numbers around 10 billion per quarter in real terms. This gives us this upward contribution of change in inventories and inside gross capital formation in this year, slowly dissipating in contribution in the next year. Then we see a negative or quite persistent decline in private investment, which we expect it will stay under pressure, also following from the foreign uncertainty, and also given that the industrial sector is not doing very well and the orders are not going very strong in Germany. So we have still relatively timid growth for Germany this year, which starts accelerating only the next. So we still see private investment being subdued, but slowly returning to growth next year. Public investment will compensate only to a small extent. Given this relationship between relatively strong domestic demand and relatively weak foreign demand, the contribution of net export is expected to stay negative. When I touched on Germany, we have a story for Germany, which I had it on the first slide, but let me repeat that. We see German economy roughly stagnating this year with 0.1 growth rate. I think slowly accelerating only the next when the easing fiscal stance, which is a part of the program of the new government in Germany, will start to kick in. We don't have this 50 billion package reflected 100% in the forecast. We expect lower fiscal multiplier, but we expect to start affecting the sentiment and the investment activity in Germany, and also translated to Czech economy at the end of this year already. So we already have some front-loaded effects of the German debt break easing at the end of this year, starting to contribute more substantially in the next. And just jumping back, this gives us this profile for Germany, which is revised massively downwards now, but then it starts to accelerating relatively fast to something like 1.5 and towards 2% growth on the back of this expansionary fiscal policy there. Again, that said, we have relatively conservative assumptions about the fiscal multipliers, which are not bad, not big, because the German economy has structural problems of its own, and many of those problems are of a structural nature and supply side nature, and the increased demand does not solve the whole story, or does not turn it around completely. But coming back to the domestic economy, to labor market, we expect somewhat faster growth in unemployment rate than in previous forecast, but not anything massive. So we expect 3.1 next year in unemployment rate. This is composed, or let's say this still a relatively low unemployment and still a relatively tight labor market. Like allows the workers to ask for above historical average growth rate in wages, both in market sector and non-market sector. For the whole economy, we have 6.1 for this year, 4.9 for the next. Being somewhat stronger in the market sector, but mainly based on the observed values. In the fourth and in the first quarter, and in the leading indicators for the first quarter, we see a relatively solid growth, but then in the more, let's say, medium-term indicators, we expect this to slow down quite fast. On the other hand, in the non-market sector, in the year of elections, and with the next government coming in, this can translate to acceleration in non-market sector wages. All this is consistent with only slightly roughly stable Euro CZK exchange rate, which on the forecast stays between 25.0 and 25.5. Of course, we observe the current exchange rate and have to work with it somehow. So the exchange rate is somewhat stronger than the forecast, let's say, but not massively. So the stable exchange rate or the mild depreciation over the forecasting horizon, but this is really nothing. This is like $20 over 2 years, so this can happen in 2 days easily. This let's say direction of mild depreciation is a result of very low growth in labor productivity being further held back by the trade war, the narrowing interest rate differential vis-à-vis the euro, and also the reduction of previously very large trade surplus. What does it imply for the interest rates? Consistent with the forecast is a decline in short-term market interest rate in the second quarter of this year, followed by stability. What are the main factors? These are drop in oil and gas prices owing to global trade uncertainty, which I've already talked about, further easing by the ECB and the Fed, and continued decline in profit markups of firms facing declining or relatively weak demand. Long-term rates will stay above the short-term rates, meaning a positive return to positive slope of the yield curve. But decomposing the change of the 3 months prior trajectory against the previous forecast, as I said, as I indicated earlier, we have this part owing to foreign environment, a composition of weak energy prices and the lower rates themselves in major foreign economies. On the other hand, we have positive contributions from domestic economy, be it the initial state, which means observed real economy data mainly. But then we have this expert judgment part, which reflects the low labor productivity against the relatively strong wage growth, which we still observed at the end of last year. We expect to see at the start of this year, and fading only gradually. So this would be the composition of the rates, but then we have the risks and uncertainties of the forecast. We still along with the board, we think that the risks of the outlook and for the fulfillment of inflation target is slightly inflationary. One of the risks is housing market, and still observed relatively rapid growth in house prices, relatively weak supply in the housing market, and renewed sentiment also for mortgage borrowing and lending. So this we consider something of a disequilibrium development. We cannot sustain a 15% growth rate in house prices for many years in a row. This wouldn't be consistent with nominal stability for the whole economy. And this is a thing to watch. And we also see it in the inflation itself via the imputed rent. Then we still observe higher growth in services and food prices. This can last for longer, can have secondary effects on inflation. Also a risk in the direction of potentially need for tighter monetary policy against the baseline. Then we thought how to work with the foreign huge uncertainty related to the trade war and the related market volatility. So we divided this into two potential directions. We can see what the market sees now, and what the market, how the market mainly interprets the situation, is that this situation can lead to a global demand slowdown. And I will show you a scenario which covers this direction. But then we thought also that in these types of scenarios, or in these types of situations where we see some potentially supply side disruptions in the global economy, this can turn to a pro-inflationary direction. So you can imagine this as a mild COVID type of scenario, when we see some deglobalization being accelerated, we see disruptions to global value chains. This can be triggered by the trade war itself. So this is a scenario which is complementary to the first one, and it shows our take on the trade war, which might be somehow non-standard in the current understanding of the trade war uncertainty, but we'll get there. Then we still have a risk from the scoreboard, increased general government deficit, which stays with us. Uncertainties, we somehow penciled in the German debt brake release, but we are uncertain how this will come out, how this will, if it will be in the magnitude we expect, how the profile will be, if the failure to vote for Merz in the first round will affect anything, or if I mean it's covered in uncertainty, let's say, and of course the future course of the war in Ukraine. For the two global like foreign risks, the disruption to global production chains and the global demand slowdown, we've prepared scenarios. Let's start with the one of a downturn in global demand. As I said, how to view the trade war is not a clear cut, but this is more in line with how the market might understand the potential impact of the trade war. We use a vehicle or modeling tool of long-term rates. So how we do it is we increase in an IG model, we increase long-term risk premia by 100 basis points, which leads to weaker foreign demand when borrowing for firms and households is more expensive. The overall economic activity is depressed. There is in the foreign GDP growth of EA6. This is already our main trading partners weighted by their trade shares. We would in that scenario face a decline of 0.5 GDP in the bottom of the effect at the start of next year. This will be anti-inflationary, bringing a lower HICP inflation about minus 0.5 percentage point. Foreign output gap will be depressed further from the baseline expectations, and the ECB would react by more easing towards 1% next year. How this translates to domestic economy as a weaker growth, the effect is somewhat stronger than in the domestic economy because of the exposure. This will also imply that our rates would need to, because of lower inflation pressures from abroad and from domestic economy, would need to move lower to 2% with weaker exchange rate. But this more expansionary monetary policy, combined effects of the exchange rate and the rates will translate to inflation not moving substantially, only by 1 decimal point or something like that. But this is maybe only a part of the story. As we learned from the COVID, we also thought that we are in a demand type of recession back then, and maybe we were in a supply type of recession. And what if the situation is similar now? We work with a relatively similar effect on the GDP, but let's say, okay, the assumption is that the global productivity declines on average by 3.5%. This is the assumption how it differs from the baseline. We have implication for effective foreign environment of a similar magnitude to the previous scenario, but with the pro-inflationary effects. The GVC problems, the supply chain disruptions, the need to restructure the whole architecture of global trade, and possible escalation of the trade war, not only between the US and others, but also mutual tariffs between other parts of the world. For example, when the Chinese trade would be redirected towards Europe, then Europe might start to think about tariffs against China. So these all developments are in fact, can be pro-inflationary. So we have this effect on HICP inflation in the trading partners, but then, despite the GDP growth is weaker, the fact that this is in fact a decline in potential output makes the output gap to turn to positive territory much earlier than in the baseline. This will prompt the ECB to take a more restrictive monetary policy stance, not doing any further cuts from now, and realizing that this is an inflationary environment and starting to realize it around half of next year and delivering one hike. How does this development translate to domestic economy? Again, similar magnitude to the previous one. Growth this year 1.5, next one 1.0. So failure to accelerate growth with inflationary pressures translating to inflation staying above the target, close to 2.5 for the good part of the forecast horizon. Rates needing or required to stay much more restrictive, so around 3.5 for the rest of the horizon, with somewhat weaker CZK as a result of some counteracting forces of higher rates, but also higher rates in the foreign economy and weaker demand. Then we have risks identified by the scoreboard, our scoreboard of inflationary risks, which mainly is the cyclically adjusted general government balance to GDP. And we have also some mild risks coming from the property prices, property price gap, long-term unobserved inflation pressures, imperfect anchoring of long-term inflation expectations, and the labor market also on the verge of being tight, but cooling off gradually. As I said, this is the summary of the forecast. Only the last two lines are averages, not end of the year. Stay aware of that. So thanks a lot for the attention. Maybe I overrun the time a little bit, but I hope you will forgive. And I give the floor back to Jarek.
Perfect. Thank you very much for the presentation. Now it's time for your questions. Just remember to activate your microphone and briefly introduce yourself, please. Thank you. Mr. Burash.
Good morning still. Jan Burash, CSOB, KBC Group. My question is about the methodology that you had in incorporating the universal 10% tariff into your forecast. If you distinguish between some kind of direct trade effect and indirect effects of uncertainty, if you could elaborate a bit more on that. And additionally, if you assumed something of a different, evolvement of tariffs of US towards Asian economies, especially China, and if that is having some kind of impact on your forecast as well, or if you took that into account when discussing risks. For example, what was mentioned specifically is the risk of inflow of cheap Chinese industrial goods to Euro area, Czechia maybe as well. So if that is something that you took into account.
Okay, thanks a lot. Maybe at some point I ask Tanya for adding some details. But let's say we keep it relatively simple. We use NIGEM model for simulating the effects of tariffs, and in the NIGEM, the effect of tariffs, especially the unilateral from the US against Europe, are going in a pro-inflationary direction. Despite the market reaction, despite the reaction we saw with some of the, okay, for example, we observed a rapid decline in the Brent prices. So this would be inconsistent with the simulation itself. So we work with the NIGEM simulation, and we do not add much on top of that. And what would be very more important would be the retaliatory measures from Europe against the US, if it would affect like more of the goods imported from the US to Europe, but we don't have big assumptions there. We keep it relatively limited to the first round of retaliatory measures, which affects only those high-end luxury goods such as Bourbon and Harley Davidsons, which is not a major part of the consumption basket. So this direct inflationary effect is very small, and it has some slight negative demand effect, but not something massive, I would say. If Tanya would add some details.
I would just add to the 10%. We also take into account in the forecast the 25% tariffs on steel, aluminium, and auto imports. You mentioned the direct effects. About the indirect effects, I would just add that they are coming from the worsening outlook for the foreign demand in the European Union. So we do not really like add something above that.
Yeah.
No. Maybe I could add on the question about the supposed Chinese reaction, whether this would cause some kind of a Chinese tsunami, if we can call it like this. I must say that during our Wednesday meeting, we didn't talk much about it, because we do not strongly believe in this possibility. Of course, it's a political speculation, but at least one member said that he believes, or she, that China will try to keep the potential trade war in a mode in which it is the United States vis-à-vis the rest of the world, not in the mode in which it is a war of everyone against everyone. So if this is the main scenario, and we believe it is for the moment, then we should not take care much about, we should not put much weight on the possibility that the Chinese goods will flood in to Europe and everywhere else.
But maybe I'll say something more specific about the 10% and how the NIGEM model works. So we have this direct effect, first of all, which is relatively small. Then we have indirect effects through trading partners, mainly Germany, but also Slovakia, which is affected because their trade direct exposure is quite big, and the effect of generally global, slower global demand. So on prices, this little bit cancels out these negative demand effects with potentially higher price effects, and for the GDP it is negative. So just adding those factors together and making the balance. Let's see.
Mr. Haverland, please.
Thank you, David Haverland from ING. I've got three questions. The first is about the exchange rate. We know that the differential is what matters, and we see that, especially in real terms, the rate for Corona got pretty positive in April, and if measured with headline or core rate, it's going to be safely positive over the outlook. Meanwhile, the euro real rate got almost to zero in April and turned negative when measured by the core inflation. So what are the fundamentals that drive the exchange rate on the weakening trend in your forecast? Because we basically see higher growth in Czechia, more potent rates, differential, solid fiscal. So where does it come from? That's the first question. The second is about the lower GDP growth for the next year. And maybe if it's only the reshuffle of the trade landscape, or whether you as well consider the lack of initiative in Europe to tackle Europe's own structural issues, because the governor mentioned that the high energy prices are suffocating the industry. So whether this would become a topic and whether some part of the lower growth comes from that. And the last question would be with respect to today's presented alternative scenarios. It seems that the reaction in foreign inflation is pretty strong, whereas it's only very tiny for Czechia. And we have seen in the kind of COVID years or with the previous kind of disruptions that the reaction for the Czech Republic was rather large. So how comes that the reaction for Czech inflation is so tiny? Thank you.
Maybe I'll start with answering the last one because I would say a good answer for that, and then we'll try also to ask Tanya for the support on the first one on the exchange rate differential and the trend. So let's say that, or the main thing, my main reply why the domestic inflation does not deviate much is active monetary policy. It's fully endogenous monetary policy reaction and expectation of like full reaction of the CNB to anything what happens. So this stabilizes inflation at the horizon, and it also leads to not only via the rates themselves, but also through the exchange rate dynamics, which deviates quite early from the baseline scenario. So the endogenous monetary policy reaction leads to the fact that the deviation of inflation in both of the scenarios, either way, is not big. On the other hand, in the foreign economy, we put some strong assumptions on the actions of the central banks. We do not believe that ECB would hike this year. So although the simulation itself done in IGM would translate to need for tighter monetary policy than we see now, we say, okay, this is unimaginable for us. So we put their assumption of flat rates for the rest of this year and start of next one, and only assume that the ECB will tighten next year in that scenario. And also on the in the other one, the reaction of the ECB is relatively like shallower than compared to the CNB. That's why the inflation seems to be more volatile or more reactive in foreign economy than in the domestic, because there is more monetary policy reaction to either of the scenarios in the domestic economy. But coming back to the to the previous questions you had on the downgrade of GDP of Czech GDP, so there are some forces which go against each other. There is this increased uncertainty from the foreign environment, from Germany itself, where we see a relatively weak growth this year with let's say the structural problems of German economy stay with us. They are only deepened by the trade war uncertainty. They are not helped by it. And this takes time also to seep through to Czech economy. So this is the, let's say, outcome of this increased uncertainty, and also of relatively weak investment activity, which we see. So this all points to slower GDP growth prospects for the domestic economy. But I have to say that next year the relaxation of German fiscal brake kicks in, but it takes time until it again like seeps through to Czech developments. Adding those things together, we have this negative revision for the next year. But again, nothing like huge. It's 3 decimal points, I think, the revision. And on the differential in real interest rates and implications for the exchange rate, maybe I'll ask Tanya.
I will just add that comparing with the winter forecast, we upscaled the expert adjustments to the labor efficiency, and because we expect that it will be quite worse this year, that we will be not improving only slightly. That because of this expert adjustment, the exchange rate is slightly depreciating in the whole forecast. The labor efficiency is then only slightly improving the next year. So this is the main factor why the koruna exchange rate is slightly depreciating throughout the whole forecast.
But I suppose it's going to be even worse in the Eurozone.
Yeah, but if we learned anything from last year and the dynamics of euro CZK against euro and euro against the dollar, then if eurozone is worse off or is not performing well, the koruna exchange rate suffers even more than the euro. So this can be a part of the explanation. But also part of the explanation is that in the baseline scenario, we have quite substantial reduction of rates towards 3%, relatively fast towards the neutral levels. So this means that the interest rate differential would be narrowing on the forecast. So, yeah.
Yeah, Mr. Schindel, please.
Jaromír Schindel, Banking Association. Thank you for the presentation. I have a question for Mr. Kubíček. We see two different scenarios. To be honest, for me, when I'm thinking about them, it's relatively hard for me to see some, red flag or sign that will tell me which scenario is actually coming. Yeah, so if you can tell me whether the bank board has some red flags to distinguish between these two scenarios which have total different impact on the monetary policy. Thank you.
It's a wonderful question, but very hard to answer. Well, we decided to have those two scenarios, which in fact, the scenarios are extraordinary in the sense that they are the scenarios which respond to the main thing, trade wars. And we are not certain which of them will develop. Of course, we know that most people in abroad believe in the global demand reduction, or how do we call it, scenario. But we wanted also to have the other scenario, which in fact perceives the potential trade war as a artificial negative productivity shock. Now the question is, which of those two scenarios will develop? Well, first of all, we believe that our main baseline scenario is the current one. The global demand reduction scenario would mean that we would have to observe a very deep decline in commodities prices, decline in world trade. Fortunately, this scenario also for our rates says, okay, you have time, 2 or 3 quarters, to decide. So you have time to observe what's happening, fortunately. The other scenario, the disruption of global value chains, again, we would see it that we would see decline in productivity or stagnation in productivity in Europe and everywhere else. So again, we have some clue if we observe this in the following quarters. We know that the scenario of so-called mild COVID, and this is super mild COVID, not to be misunderstood, please. And our reaction in this scenario is not to do nothing for next quarters again. So we believe that the risk of potential monetary policy mistake or error is not that big for the moment. So we will observe the data and then we will decide. This is my response.
Okay, any other questions? Okay, Mr. Stupovsky.
Hello, Michal Stupovsky from Konsek Investment Management. I have two questions. First one on your assumption for the Fed monetary policy. You mentioned on the slide number 12 that you expect that the Fed will continue easing its monetary policy. However, taking into account, for example, Bloomberg consensus forecast for this year, inflation forecast has been creeping up during the last several weeks or even months quite substantially. So in my opinion, we cannot be certain at all, sure at all, that the Fed will continue with decreasing Fed funds rate till the end of this year. And the second question is on your Czech forecast and on the GDP for 2025. This year, you maintained your forecast at 2.0%. However, again, looking at the Bloomberg consensus forecast for GDP for this year, both the world economy as a whole in general and the German economy in particular, we've seen during the last several weeks, again, some deterioration, declining of the forecasts, which I think triggers some deterioration of the foreign demand from the Czech economy. So I would assume that some of your assumptions for the Czech domestic demand must have been improved for this year. So what have been the key drivers of that? Thank you very much.
Thanks a lot for very nice questions, both of them. For the Fed, I will jump back to the first slide. It's true that we have made our, let's say, cutoff dates or cutoff times for the market outlooks at the time when the market expected more than 1% point of rates cut for the Fed in the coming year or year and a half. So this is maybe even 1.5. So this was priced back to some extent. I think now it's three cuts this year, or maybe even 2. So this might be the main difference in the market outlook as it is now against to our cutoff date. So it goes in the direction which you mentioned, but not all the way. I would say that still there are cuts expected from the Fed, and despite the inflation is creeping up, there is a pressure on Fed to do something, and we are there almost agnostic, that we take the market outlook and do not make any judgments of if the Fed will give to the pressure or not, or if they will resist. So this was a market outlook around half of the month, like 2-3 weeks ago. Same for the ECB. I think it was repriced upwards a little bit. So these are the main, let's say, I would say, differences in the foreign economy, like from what we assumed in the forecast against what is the current state. But the direction is still there. And another question was for the GDP forecast of 2.0. Again, this is a mix of stronger observations, mainly in the private demand and the household consumption and domestic demand in general, and weaker fixed investment and a weaker, let's say, short-term outlook for the rest of the year. So this, the stronger observed demand, stronger wage growth than we expected, stronger consumption of households against, let's say, weaker foreign demand and weaker gross fixed investment formation. Anything to add for this year? Yeah. Okay. So this would be it.
Okay, so time for last question, Mr. Jáč, please.
Good morning, Radomír Jáč, General Investment CEE. I would go, if I can, back to this issue of two scenarios for tariffs. Well, as Mr. Kubíček indicated, at the end of the day, you will have time to evaluate responses from the economy and from the markets. But in my opinion, I can very easily imagine that actually you are, in your two scenarios, describing per partes two situations which at the end will exist at the same time as a mix. Because for sure, with tariffs, you will have problems with global value chains, which will be increasing costs. But for sure, you will have weaker GDP at the global level, if you will, weaker global demand with some impact on commodity prices. So what if you mixed it together? If I just very simply look at your charts, and it's pretty logic, simply it tells you the Czech crown would be weaker in both scenarios. But for the monetary policy for interest rates, it's difficult to say whether any response is needed. So if you can tell me.
Well, I, in principle, agree what you have just said. Because definitely we will see a negative productivity shock to some extent. The question is to what extent. And yeah, we cannot do anything more than what we have done. Yeah, some risks are hard to quantify simply. And if I may just sum up what we talked about last Wednesday, is that we should not overreact because simply, of course, with the notion that monetary policy has to be forward-looking. But if you just cannot see through the very dense mist, you just are sentenced to wait and see in this situation. My colleagues.
Yeah, I mean, I think you answered yourself to some extent. That we thought this will help us to chart the territory of potential, how the situation can unfold going forward. The first one, on the global demand slowdown, more in the direction how the general market understands that. What we also hear from our guests, from foreign investment banks, for example, how the market sees the risk, and mainly in this direction. But then, if it unfolds more in the direction of disrupted GVC and lower global productivity, we can have also cause for need for tighter monetary policy worldwide. So we wanted to show this possible two direction of where it can go. You're right that most likely we will see a combination of those two. But then it will not give us this like two possible directions to show the degree and the size of the uncertainty we are facing.
So thank you. So time is up. Thank you for coming, and see you again next time in August. So goodbye.